that there is no algorithm. They're going to tell you that there's no rhyme or reason to the candlesticks. There's no justifiable means to an end by looking at the things that I'm showing in the chart. They all just cherry pick. That's what they're going to tell you, but you're seeing that is not true because you're watching me do it live. We made our way to the 1 minute chart. All right, so we're looking at the New York Kill Zone. New York Kill Zone is the same for Forex, okay? It's basically the 7 a.m. Eastern time to 9 a.m. Now, you can extend that 1 hour before and 1 hour after and just completely answer all the problems of daylight savings time. That's what I taught in my private mentorship. My students know this, so I'm giving it to you for years as well, so that you don't have to pay for that. But if you're going to be a purist, I mean that you're going to stick to the rules as I first presented them, it's 7 a.m. Eastern time to 9 a.m. Eastern time. That's essentially, in futures trading, it's pre-market trading. So you're trading ahead of the opening bell at 9:30 Eastern time. So if we look at the NASDAQ on Friday, let's break that down in here. So we have 7 o'clock, starts this period here, all the way through till 9 a.m. Eastern time. We have relative equal highs in here. The market rallies up, takes that buy side liquidity. I'm going to challenge you to go further to the left on your chart. I'm purposely leaving a lot of things out of these charts because we're going to talk about journaling at the end. So it's kind of like the Shotgun Saturday encouragement and or where I talk a lot of things that not necessarily are appearing in the charts. That's the part that most people don't want to listen to. But these are the things that help you become a better trader and use the information I teach technically correctly. But look to the left a little bit further over here on your 1 minute chart, and you'll see there's a fair value gap that it trades up into there. But sticking just to the liquidity aspect, the buy side's taken here, and then we break below that short-term low, which is what?
Nice.
A shift in market structure is bearish. Then the market trades higher. This is model 2022 in and of itself.
Perfect. Yeah.
For the folks that guys, I ain't seen it working in months. You don't know what you're looking at, but it's working every day. The market breaks down, and this is an institutional order flow entry drill, and that simply means
okay. So delivery off of a hard time frame fair value gap inside of the New York Kill Zone, takes buy side, shifts in market structure, trading through an opposing array with this down candle, trades up into a fair value gap. I mean, just classic stuff, really. Then here's the order block. So we'll keep watching this.
This candlestick didn't get completely filled in or closed in and repriced back to the previous candle's low. This candlestick's buy side imbalance, sell side inefficiency. Then this SIBI, sell side imbalance, buy side inefficiency, creates a balanced price range there. That's why you would expect to see an institutional order flow entry drill. The easiest way to anticipate the institutional order flow entry drill is if there's a balanced price range in the fair value gap that it's trading up into. 9 times out of 10, if you're bearish, it's not going to completely close that in. And that means that you can do a very shallow run above that high as your entry and not try to use the consequent encouragement or the entire range closing in on the fair value gap.
With screen time, you'll notice this as well.
And then we break down with displacement again. And all of these candles here, the lowest opening price, that's a change in the state of delivery, trades up into the bearish order block, and then it breaks down there. Once we get below this low here, we do so on a expansion. It's heavy displacement, meaning we have a candlestick that creates what? A fair value gap. Since it's done that, below this low, and here's the main thing, we talked about this in Telegram before it reached it. I told you in Telegram, I'm interested in getting below that balanced price range of the 18th and the 19th of March. A big block of price action. Okay, if you're a member of the Telegram channel, it's free. The actual official link, you can find that on my YouTube channel in the description portion of the channel. It's right next to where I post my X link to get onto X and watch whatever I'm posting there, and then my main website, which is theinnercircletrader.com. It is likely to trade down here. So that means we were looking for this. So the draw on liquidity is what? Is it bullish? No, it's not. We're up here. So this displacement here, once it gets below this low here and does that, we want to see it stay open. And if it stays open, it's going to act as what? A breakaway gap. Then the market breaks faster, and then we have a big sell side imbalance, buy side inefficiency, right where it should form. What do I mean by that? Well, if you take this gap here, it's roughly, by eyeballing it only, it's about halfway from the high to where it's formed to where that line is here, that red line at 19,604.25. That's the low of that balanced price range, that big block of price action I shared in Telegram, of the 18th and the 19th of March for NQ. I wanted to see it go down below that and explore below it. It did. It went down a tick or two below it and said that's enough for me and went back up. But that's still what we were looking for. So if this was the draw on liquidity, and best case scenario would be trading down to that sell side. I made no mention of this as a hard selling point. This level here absolutely was called in advance in Telegram. So you're seeing 33 years of experience of knowing how the market's likely to draw to these very pools of liquidity. Now, admittedly, on Thursday, I believe it was, I thought that we could potentially trade to Wednesday's high when we were in that parabolic run up because it's FOMC week. It's likely to happen, and it didn't deliver that. Okay, so while that didn't deliver, does it mean that the concepts fail? Does it mean that I don't know what I'm doing? Does it mean that they're changing the algorithm? Absolutely not. It just means in a week like FOMC, you're probably going to get it wrong. And the day after FOMC, well, it's not a stretch to assume for a moment that imperfection is likely to creep in to everyone's analysis, and I'm no exception to that rule. So once the market reaches down here, we can very easily see that that was a measuring gap. But I'm sure you probably want to see some more details to prove that was a measuring gap, right? As the market breaks down, since you know this level down here is that low of the balanced price range of the big trading range of the March 18th and 19th price action, you can drop a fib from this high, and we'll do it here. You anchor your fib to the high and you pull it down, okay? So since this is a static chart and it's not me doing it live over a chart, imagine my cursor's just like that. I'm holding it right there. I want you to take your attention to that red level right there. That's the 50% level in the Fibonacci. As I pull the fib down, I'm trying to eyeball this 50% level and line it up with the middle of the measuring gap. So I'm going to overlay this red line with this dotted line, which is half or the middle of this sell side imbalance, buy side inefficiency. So I'm going to pull it down from here and I'm going to aim for that level right there and drop it. And it looks like this. So I pulled the fib from this high all the way down. There's where my cursor would be until the 50% of the fib anchored to that high. It stops me here because the 50% level laying over top of the consequent encroachment of this gap, that gives me the perfect measurement for measuring gaps. Okay, or it's basically like the equilibrium or grading a price swing. We can anticipate where measuring gaps are going to form if we know where the draw on liquidity is. Isn't that fascinating? Isn't that fun? How about where does the breakaway gap form? Around 20 to 30% of the implied dealing range. What's an implied dealing range? Implied dealing range is when the market was up here and you anticipate selling off. Where's it going to sell off to? Well, we wanted to see it go down below that 18th and 19th balanced price range of March. That's this red line down here. So we can take a fib and just loosely take it from the sell-off point and drop it right on the red line here, and you're going to get a general proximity where that midpoint is. But it's further refined when you actually use what? Price run in and of itself as it forms, candlestick by candlestick. So here is the upper quadrant of that implied dealing range. An implied dealing range is a price run that has not completed yet. If you're bullish or bearish, where your terminus or target is, which is this level here, that was qualified and quantified inside of the Telegram channel before it reached it. So by having projections like this, we can grade our price swings. And breakaway gaps are wonderful to anticipate near the 20 to 30% of the price range that has yet to deliver, and then 50% of it. See that? Now, in and of itself, to me, I thought that was very fascinating when I was coming up and I was seeing these types of things in my own analysis. I was like, wow, I've always seen books talk about gaps, common gaps like breakaway gaps, measuring gaps, exhaustion gaps. They're not my concepts. I didn't create them, okay? But I did come up with a concept that I'm teaching you here, which is implied dealing ranges and anticipating where they're going to form, where they're forming. And on top of that, you can anticipate the time they're going to form. That's going to be outside the scope of this lecture, but I will have it in volume 3 of the books that I have worked on. I know. Come on, ICT, come on. I can't put everything in a video, okay? But I will teach it, I promise you. So if we know that this is the midpoint, which qualifies and confirms this is a measuring gap, this level right here stops when we get this overlapping of the midpoint and 50% of the fib. This level here, pay attention now. Look at the bodies. See that? Isn't that beautiful? So you're telling me, seriously, this is fun. You're telling me that the buying and selling pressure just happened to form all the bodies right there, but the wicks are allowed to do the damage. What did they do? They went down just below that low I told you, that the 18th and the 19th balanced price range formed. And it went down below it by a tick, and then it came right back up to close inside of the level that's projected for a perfect measured run. So the implied dealing range came to perfect fruition, and it's confirmed with what? Look at the bodies. Stopping right where the fib qualifies, that being the measuring gap.
So real quick, I want you guys to put a thumbs up in the chat if you remember me the last month. I wasn't teaching you breakaway gap, I wasn't teaching you measuring gap, but I was teaching you guys in live price action, right, to target those equilibrium gaps, because a lot of times that measuring gap is going to be left open, right? So this actually brings the dots a little bit more together. So if you're looking at a market maker buy model, you can see how it creates a sell model. and leaves that measuring gap behind. And it's such a high quality target because it's closely correlated with equilibrium, right? And I've been showing you guys that live time with my runners that I actually target that equilibrium for value gap and use the implied dealing range for what? Model number 2. So this kind of pieces that type of stuff that I've been showing you guys together a little bit more. So you should definitely take notes on this, to be honest. Okay, so that's actually good stuff there. So I'm going to mute my mic again and we'll finish this video up.
Staying in that level of that implied dealing range. Then it starts to rally. There's details in here. They're going to ferret out. But you can anticipate price doing what? Breaking this high. Now, why? 9:30, we have the opening range. The opening range is 9:30 to 10 o'clock Eastern time. Now, I know there are a lot of folks out there that they'll say opening range, this or that. Some guys are saying, here's the first 5 minutes opening range. There's guys that say, okay, here's 15 minutes opening range. Here's this and here's that. I'm telling you, it's 30 minutes. I promise you, you're going to see why it's 30 minutes today, okay? But I want you to understand that anything outside of 30 minutes is just an opinion, and that's why you're not seeing them show what I'm going to show you today. What I'm going to show you today is going to blow your socks off. I promise you, any other time element isn't going to match up with what I'm showing you here today. And that's what I'm trying to twist the arm of the individuals that are just wanting to argue, whether it be in my own comment section or in other people's. I read it, I look at other YouTubers, and they're always, having my name in their mouth. And they're talking about how this, that, I think there's no algorithm. But they never want to put up against it. They never want to show whatever they're doing against what I'm proving live in front of almost 100,000 people that did not pay me to be in there watching me doing it. I want you to think about how the opening range of 30 minutes, what do we do with that information? Well, obviously you have to know the low of it and the high of it. And that's what I've annotated here. So by having that range defined, we start looking for first presented fair value gaps. Now, if you're an order block trader, you're going to wait for the first order block to form that's salient to your bullish or bearish stance on the session. It may be breakers. It may be a institutional order flow entry drill. It may be a propulsion block. It might be a volume imbalance. It might be anything that I've ever taught. That's your PD array. But I'm pushing the first presented fair value gap because it's good. It's like a silver bullet. It's there. It's always going to be there. But there are some aspects to first presented fair value gap that I want to include here today. If you have a very small, and there's going to be times where you look at the individual price action of any given day, and you may question, is the first fair value gap really valid, or should you use another one? And the general rules are this. Obviously, when we're looking at inside this range, from this candle's high to that candle's low, that's the actual range. But the range in time is here from 9:30 a.m. Eastern time to 10 o'clock Eastern time. So you're having to look inside that portion of time for the very first presented fair value gap or the very first PD array that you're going to employ as your model. The easiest one to spot is the fair value gap. All you have to do is narrow your focus down to the first 30 minutes because the algorithm is going to leave something there for smart money. It's coded to do that. Buying and selling pressure is not forming that. It's not a one print, single print, as you hear people try to call it. It has nothing to do with what I'm doing. Absolutely has nothing to do with it. You've never seen anybody use single prints that invert. Now there's an inversion of that first single print. It's all garbage. These people are just trying to find some way to make it look like this stuff has been in existence forever. But unfortunately, I broke the mold when they said there's nothing new under the sun. And that's the kind of stuff that makes me sound arrogant. But I'm just simply poking you all that are resisting. Just simply look at it. Because if this stuff existed somewhere else, other people will be doing that other stuff and doing things that I'm doing, showing precision that's unrivaled. Remember, if all that stuff happened and been in books and people have been learning for years, hundreds of years or whatever, why aren't they doing what I'm doing? Why aren't they showing it, proving it? Arrogant here. I'm being very sincere because I think that someone else, they haven't done the due diligence of going through all the material that I've watched all those videos and because I liked them and they wouldn't lie to me, come out here and said anything. And because I said it, you need to answer this today. If you don't think there's an algorithm, you need to swallow this big pill because this is going to be a jagged one. Moving range, 30 minutes, 9:30 to 10 o'clock Eastern time.
Okay, let's
You're
see.
looking for the very first presented fair value gap.
What do you got,
if
Michael?
the gap, as you'll see here, that's the very first one. See it? There's no other fair value gap on the 1 minute time frame. forming prior to that right there. Now, would you agree that that's a very small fair value gap? It's minuscule. And it really didn't do anything, did it? Did it take price down to take a lower low out? No. So there's one strike against it. We already made the low of the day at a level we anticipated. So if we went down here, isn't it likely the market's going to go higher anyway if it rejects like it's done here? We have a shift in market structure, and then we're inside of the opening range of 9:30 Eastern time. So we're only coming back down to test that low. And it didn't even get down to the low of that 18th and the 19th balanced price range. So as I teach, the signatures are, we want to see levels fail. We want to see PD arrays fail. That's insight. You don't see anything in Wyckoff, supply and demand, or anything else out there that says we want to see certain things fail. Because all those books were written before an algorithm existed. The logic that these algorithms that are used to trade, they're highly sophisticated entry models, but the delivery of price is controlled. And they have to try to engage the price runs just like you and I do, and they may not get filled. Because the algorithm is doing all of the delivery. Think about it. Why didn't it go down below that low? Surely there's somebody down there, a collection of individuals that are long. If they're long, what's going to be below that low? Sell stops. Why couldn't it get down there just to go one more time? What's the logic that says, nah, it's not enough? And there wasn't enough sellers there. The selling pressure was abated, and the buyers came in. There's more buyers. Why? Tell me why. Why right there? You're just going to give me an opinion. But what I'm going to show you today is not opinion.
Okay, let's see it. Come on.
It's time-based delivery.
Let's see it. Oh, man.
Precision. And it repeats every single day.
Okay.
And that's what I'm trying to inspire in all of you, because we're going to talk about journaling at the end of this. And I want you to look for these things I'm going to show you here, and that's what you're going to journal. But without still...
Disclaimer, I'm in complete agreement. I am in complete agreement that this thing is solely booked on an algorithm. I mean, you can say whatever you want in the comments. I mean, I've had way too much chart time to not be a believer in these markets specifically booking on an algorithm and already being predetermined before any candle prints on where it's going to go, where the high and the low is going to be, all that type of stuff, right? Too much screen time and just way too many repeating phenomenons at very specific times a day that actually happened that suggested there is an algorithm here. So the fact that these things do repeat on algorithmic delivery is the only reason why I have an edge. The reason why the fact that these markets are manipulated to the tick is the only reason I have an edge and can pick up on these repeating phenomenons as a result of that. So that's my 2 cents on that.
Under that portion of the video, let's go into this in a little bit more detail. Small little gap like that. That's the first presented fair value gap of Friday, March 21st, 2025 on NASDAQ. June delivery contract. It's a fair value gap that's a SIBI. So that means generally that would be treated as what? It trades back up into it and sell off. But that's canceled out because we reached our target. Now we have a shift in market structure here, and we didn't take out the low there. So we're inside of the 9:30 to 10 o'clock opening range. So if we take out that high, we really have what? We have a move outside the opening range higher when it should be bullish because we've hit our target for the week, and we rejected it here. So wouldn't it be favorable to see a larger fair value gap than this one?
Yes.
That's in an opposing direction. If this is a SIBI fair value gap, in other words, it's a down close candle, this is what you see the opposite of, which is a BISI, buy side and balance, sell side efficiency. And notice the difference in contrast of its displacement. Significantly larger, isn't it? This would be your very first presented fair value gap within the context and narrative of what you have in price action here.
Okay, got it.
When you see people on X, or if you were seeing the comments that are left in my videos all the time when I'm sharing executions, they'll say, why didn't you use that fair value gap? Why did you use that one? Why did you choose this one? Why did you choose that one? This is what I'm doing. I'm looking for things that have a greater displacement that is in the context of the narrative, what I think price is going to do. So this would be your first presented fair value gap because it's a larger displacement and much more significant than this little tiny thing here, okay? Then market trades above the opening range high. There's your breakout. We don't trade breakouts, but that's a break above it. We don't need it to close above it.
Solidifies bullish bias. Okay,
market trades down,
chase it right away.
Into that again, right there.
Understood.
What time is that occurring? At 10 o'clock. That's your silver bullet. It forms every day, folks.
Okay.
There's never been a day where silver bullet never formed. Now, ask your mentors, ask your educators, ask whoever is a bigwig in the industry. Tell them to come forward and say that their concept forms every single day without fail. There's a lot of them ain't going to even come close to wanting to say that, but I will, and I'll show it every single day. Every single day. My stuff doesn't stop working because it's algorithmic. It's all time-based delivery, okay? And that should already get you excited, but we ain't done yet. The market rallies again and trades into that old measuring gap now because we went above it here, and we've got the narrative behind us that it's likely to trade higher now. This inefficiency that was a sell side imbalance buy side inefficiency or measuring gap, now we can treat it as an inversion fair value gap. Look at that. Look where it's forming. I mentioned on X that you would have a lot of ideas thrown at you. Here's one of them. If you have a market that's changed gears and direction, now it's bullish. If you can get above the opening range high, and if there's liquidity obvious in the charts, here, this gap over here, when it was going up to run the liquidity out, that's a buy side sell side efficiency. But when the market changed gears, that turns this into what? A premium array in the form of an inversion fair value gap. The market goes down into the opening range high and the low of this inversion fair value gap. That was the measuring gap. So it's forming basically a pseudo market maker buy model. Okay, that's what's basically forming.
And very ugly one.
Bodies real close to inside that inversion fair value gap, but it hits the opening range high and then creates another fair value gap there. Trades outside of that inversion fair value gap, comes right back down again. Here you go. This is another silver bullet inside the hour of 10 o'clock. Displaces to the upside, runs.
So basically the best thing I got out of this is you can look to utilize specifically a time-based high as old resistance coupled with, you know, the narrative of like an inversion for value gap and so on and so forth. So that's, you know, good insight there.
Buy side here and trades right up into the inversion fair value gap. And we don't even need that buy side taken there for that. Those are two trades right there that are beautiful. Right away, you can see that there are times when we can use the actual opening range that the algorithms are referred to. It's 30 minutes, folks. It's not 15 minutes. It's not 5 minutes. It's not anything above or below 30 minutes. It's always 30 minutes. Period. Moving forward in time, here's that inversion fair value gap that was projected over here and that buy that was running off of that. Then the market retraces and trades down. And what is it doing? It's trading back inside of the opening range. I'm not saying opening range gap. It's the opening range. It's the first 30 minutes, 9:30 to 10 o'clock Eastern time. Now, I have added the Fibonacci to the opening range, low to high. That's what I did here. And I added the upper quadrant and the lower quadrant. Now, if I'm bullish on a market and it trades down inside the opening range, I'm going to be watching that upper quadrant. Oh my.
Okay, that's actually good. It's something I honestly didn't know before. So that's actually, this is like one moment where I can say like, wow, like I'm actually learning something here in terms of something I didn't, you know, particularly have good awareness of on the chart. So.
Oh my. You feel that tugging in the corner of your mouth? Go ahead, let it happen. Smile. It's fun, isn't it? That trading down into that upper quadrant of the opening range, the first 30 minutes of trading, 9:30 to 10 o'clock, that's algorithmic. It's also occurring at a very specific time. This is where the lunch macro begins. 11:30, right here. That starts that whole overlapping of what already has happened. What's happened already? The market traded lower. From here, there's buy side resting above that. So at 11:30, whatever you've been doing, anticipate some measure of retracement and growing the other direction. Not all the time, but the majority of the time you're going to see that. Now in this case, because we had the target reach for the week, it's probably going to go higher. And this is the lunch macro. The lunch macro is 11:30 time, Eastern time, as far as 1:30 p.m. Eastern time. So it's a 2-hour window of time that's collectively referred to by me as the New York lunch. Okay, so by hitting the upper quadrant of the opening range, when it's bullish, you can time an entry in here to go higher. Now you can use an inversion fair value gap here. You can use a turtle soup, or you can anticipate the run back above here and trust that it will give you a fair value gap, some kind of a order block. In this case, you can see very, very beautiful immediate rebalance there. And then starts to run higher. These levels are standard deviations. The standard deviation of the opening range, the first 30 minutes, 9:30, 10 o'clock. This is,
okay.
I have a standard deviation, one standard deviation.
It's really useful stuff, but to be honest, I don't think I would add it into my real-time charts
right here,
when I'm
beautiful
trading
delivery,
real-time.
algorithmic, all perfectly delivered.
Like, this is all great, and this is beautiful, like, looking back on it, and it's, like, perfect delivery, but, like, with my models I have solidified, I just simply, like, to be honest, wouldn't need this type of stuff, but it's something that I would have in the back of my mind and surely reference, but not, like, when I'm trading real-time, I'm not going to be like, oh, you know, quadrant of the opening range gap is why I'm doing this and that. No, because I already have my model solidified, okay?
Now, at that point, we're going to take our attention and scrub forward again This gap here, we're going to extend it forward now because price is above it. I'm not going to change the color because I don't want you to lose sight of what it is I'm referring to in proximity to that. So just know that once we went above it here, this would be referred back to as a reclaimed bullish fair value gap, not a bearish fair value gap. But I want to leave it this way so that way you can follow it. That's it here, extended all the way over it. So here's that run up to that standard deviation 1.5. And then one more time it bumps above it and trades down into the lunch macro ending at 1:30 p.m. And now we're creating what? The opening range, the first 30 minutes of 1:30 to 2 o'clock Eastern time. That's what sets the tone for the market structure. All of the magnificent and precision-oriented aspects of that
PM opening range.
It all starts from here, 1:30 to 2 o'clock. Find that in Wyckoff. Find that in Elliott Wave. Find that in anything. It ain't there, folks. It's simply not there, okay?
True.
The Mac Daddy, the real McCoy, he's telling it to you right now. I wasn't wanting to teach all this stuff, but it's just simply fun to just twist that knife in the proverbial sides of all these people that say it isn't real, it ain't there, it's all buying and selling pressure. Really? So we have the opening range low. This is the lowest low between 1:30 p.m. Eastern time to 2 o'clock Eastern time. That's the highest high it formed. This is the time aspect. Okay, this is the parameters on time. This is the opening range low, the lowest inside that range of time. So if we were following it down here, 2 o'clock to 1:30, that's what this is showing here. It's the end of the lunch macro. So now we're anticipating another run in price action. And since we've already anticipated a reversal because we hit our weekly target, so we can anticipate what? A continuation to the upside. See how that's we work together to build a narrative based on what has happened and what's less likely to happen. Less likely for it to continue lower because we already traded below the weekly target of the 18th and 19th pound price range. And it rejected strongly on a Friday. So now we have the opening range high. And then inside that opening range, here's your first presented fair value gap. Oh my goodness. This looks like someone's put this together. Like there's a real storyline behind all this. That's what I've been trying to tell you. But I didn't want you to take my word for it. I want you to see it for months and years. And the folks that don't want to see it, they're in denial. They're in denial. Honestly, I'm beginning to think that it's a paid opposition now to try to dilute your attention to it. It's false. Again, the cat's already out of the bag. And, to me, I think that's delicious. But the market trades down into that first into the fair value gap here and rallies up. That right there is a tradable run. But now we're going into a macro, 250 to 310. And the market's doing what? It retraces all the way back down to -1 standard deviation of the opening range of 9:30 to 10 o'clock. That's what these lines are here. Okay, so again, we go down to that inversion fair value gap, which is technically a bullish reclaimed fair value gap. It rallies and consolidates inside now the macro of 315 to 345 Eastern time. I promise you, no one ever talked about that. No one has ever mentioned that, ever. I did on Twitter Spaces. I talked about these things, okay? And you can find them all on YouTube because I give permission for people to put them up. That was the reason why I did that. I don't care that they make ad revenue off of my Twitter Spaces, okay? I said a lot of things language-wise that I didn't want to have in my YouTube video. And I trolled people inside those Twitter Inversion, off of that part of it. I don't mind. It's come back to me. But at 3:15 to 3:45, the last final hour of regular trading hours, you call it the power hour. I don't call it power hour. It's the final hour of regular trading hours. Between 3:15 and 3:45, the market's going to operate inside of the narrative that's presently underway. Meaning what? We created another opportunity to buy. We have buy side up here, which is also the opening range high of 1:30 to 2 p.m. Eastern time. That's the afternoon session. You don't see me do a lot of afternoon session stuff. Usually I'm in other people's live streams or whatever, and the things I call out and it comes to fruition all the time is what I'm showing you here. I'm literally showing you my cards. Now, it's going to take a lot of experience to do what I'm doing. Just by me showing you this isn't going to be enough. But look at the times that these things are occurring. They're very specific. They're very, very specific. If you look at the high here, that's a macro. That's a macro. That's 1250 to 110 macro. And what does it do? It retraces back down into that gap. And it's also trading down into -1 standard deviation of the opening range at 9:30 to 10 o'clock. Forget pivot points, folks. Forget all that stuff. You need to look at these things, okay? Pivot points are not based on time. They're not based on any time. They're just ambiguous measurements of open, high, low, close, multiplied by 2, divided by this, all that stuff is number crunching. When you take your attention to time, and that's why I laugh in the face of these fools. They talk about, oh, I'm the price this, I'm the price that. I'm the prince of price action. You're a fool if you're not implementing time first.
Jordan of price
because
action.
that's what the algorithm does. It refers to very specific times. And then what price inside that range of time. See, these aren't zones. They're highly specific 30-minute windows, 20-minute windows in deference to the macro or, in this case, the lunch macro, which is a 2-hour window of opportunity, but there's a beginning to it and there's an ending to it. And there's price runs that begin and end at those very specific times. When you're journaling, I'll hold off because I'm going to steal the thunder from that portion of the video if I keep going on. But during the 315 to 345 macro, it's 30 minutes. You're looking for the setup that leads to market on close macro. That's what MOC stands for. That's the 350 little price run that usually takes off and creates another higher high or retracement into the range. Here, we know that we have 2.5 standard deviation that would take us above this high. This one's very close, but if you look at this price run here, it duplicates itself there. So we're seeing another measured move, but it begins at the time and on the price inside of the opening range in the afternoon session. That's this one here. Look what it's doing here. Body stopping at the consequent encroachment. The wicks go down just below, but doesn't completely close it in during the 315 to 345 macro. Bodies are staying in the upper half. What is it telling you? The algorithm is signaling to smart money, just like it's been coded to do. Stay out of that area. That gives them confidence that that's the setup to buy and run it into the close. And look for rocket fuel at 350. And here you go. That candlestick's 350. And wouldn't you know it? Look what happens. Right up to negative 2.5 standard deviation. So there's obviously no algorithm, right? No way. Nope. Not here, folks. Nothing to see. I want you to think about the power of journaling.
Okay. So, yeah, that was a pretty good video. Pretty good insights. Definitely good. My, only negative thoughts, I guess you can say, not really even negative. I just think that a lot of newer traders watching this this is really going to open the door for them to get really, really confused. While all this stuff is very precise, it's accurate, it works. It's obviously booked in an algorithm. You can fight me or not, I don't really care. It's just, 5 years of screen time, it's pretty hard to not see that this stuff works over and over and over and over again. But with that said, all this stuff can be very confusing for someone that's trying to learn. You don't really need all this stuff. Time you absolutely do need. Time you absolutely do need, but everything in between that, everything else that was talked about in here, you really don't need it, to be honest. At the end of the day, you need highs, lows, fair value gaps, and time, and it can be as simple as that. So while all this stuff is nice, and you should obviously note it down and be aware of what, how price actually books, I don't think you should try to bring all this stuff inside of your analysis, because it really opens the door for you to overcomplicate things, overanalyze, analysis paralysis, all that type of stuff. So just don't get distracted and put in every single concept under your chart, right? Just simplify it. Fair value gaps, highs, lows, time. That's what I do, and I believe you guys should find your own unique model that's very simple and works. And just one repeating phenomenon is all you need. Okay, so don't watch videos like this and feel like you have to bring every single concept in the equation and think you need to know everything, and you need to know the why for every single price swing. You don't need to know that. All you need to know is one repeating phenomenon in price, and that's it, and you'll be on your way, and you'll be very successful trading these markets. Okay, so that's my thoughts on this.